Welcome, guys, to chapter 3. In this this week, we are only going to cover the first part of chapter 3. In my opinion, I think this is one of the toughest chapters because we cover so much. So that's why I'm going to just break this into 2 weeks. In this chapter, we're going to talk about the accounting cycle. So we worked on chapter 2 last week, and we went through the process of analyzing transactions and recording them and posting them and coming up with a trial balance. And that trial balance was just a list of debits and credits. That's kind of where we stopped. In this particular chapter, we're going to understand some more concepts, and we're going to understand some various adjusting entries, journal entries we're going to need to do in order to prepare financial statements. Now, remember, those financial statements are the way we communicate information to external users. So as we start this chapter, we're going to talk about a concept that is crucial in financial accounting called accrual, the accrual of accounting. Now, what does that mean, the accrual basis of accounting? Well, there are 2 aspects related to the accrual basis of accounting. What that means is we record revenues. Revenues are the earnings of a company. We record these revenues in the period in which the goods or services are provided to the customer, not when we get paid for those services, but when we actually complete those services. This is called the revenue recognition principle, which means we actually provide a service or provide the goods and recognize that revenue at that time. The money can happen before or after. That's why we have accounts receivable and sometimes our revenues aren't linked with getting that cash. We may show an accounts receivable, but we actually record the earnings when we provide the services or goods. On the expense side, we record expenses in the same period as the revenues they help to generate. So if there are expenses, and there will be, associated with making that revenue, that's when we record those expenses. We refer to this concept as the matching principle. We match the expenses with the revenues in which they help to generate. Remember, the revenue recognition principle states that we record revenues in the period in which we provide goods and services to customers, not necessarily in the period in which we receive the cash. This is a great example, guys. So this shows how the expense recognition principle or matching works. So there's a cruise ship. The cruise is going to happen in April. The cruise is going to happen in April, but there are various costs to get this cruise happening. In March, the outflow of purchases of supplies occur. Excuse me, one sec. Then in April, the cost related to fuel occurs. And then in May, all the salaries are paid. Now the revenue occurs in the month of April when the service was provided to the customers. Therefore, March, when the supply was purchased, April, whoopsie, sorry about that, guys. April, when the fuel was purchased, and May, when the salaries were paid, all happened in 3 different months. However, all of those expenses will show up in April and be matched with the revenues that occurred in April. So remember, expenses are recorded in the same period as the revenues they help to generate. Expenses that are indirectly related to producing revenues are recorded in the period they occur. So guys, this is a multiple choice, and we have 11 people in here besides me, and I'd love to see 11 answers in the chat box. Which statement best describes when expenses should be recorded? A, expenses are recorded when they're paid. B, expenses are recorded the day a company promises to pay. C, expenses are recorded when the cost is used to help produce revenue. Or D, none of the above. What do you guys think? There's 9 answers in the chat. We need 3 more, or 2 more, I should say. Well, how many? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 people. We need a couple more, but C is the correct answer. Okay. Now, we're going to understand how the accrual basis is different from the cash basis of accounting. The accrual basis means we record goods and services when they're provided to customers. However, the cash basis of accounting is we just record revenue when we receive the cash, period. Do you see how that's different? As far as expenses go, the accrual basis of accounting says we record the expenses in the period that those costs are used to help produce revenues. But under the cash basis of accounting, we just record those expenses when cash is paid. You see the difference? Cash basis is money. Cash in, cash out, that's only when we record it. But financial accounting is different. We are required for most companies to use the accrual basis. And we record those transactions when we actually provide the services to customers, we record the revenues, and we report the expenses in the period those costs are used to produce the revenue. No, the accrual basis is GAAP, generally accepted accounting principles, period. The cash basis is not GAAP. So let's take a look at these, and let's look at, on December 12th, we provide golf training to customers for cash. Under the accrual basis, was the service provided? Yes. That means the revenue was recorded. Under the cash basis, was the cash received? Yes. So under both methods, we would be recording this transaction, because for accrual The service was provided, we recorded. For cash, the cash was received, therefore we record it. Look at this one. We provide golf training to customers on account for $2,000. Now, when it says we provide training to customers on account, that means we did not receive the cash, but we did perform the service, provide the service. So would we record it under the accrual basis? Yes. But we would not, under the cash basis, record this until we receive the cash. Now, this is an interesting one. We receive cash in advance for 12 golf training sessions to be given in the future. Did we provide the service? No, we didn't. So under the accrual basis, we wouldn't record this as revenue. We would treat it as a liability. Remember, we would debit our cash, credit deferred revenue, which is a liability. We learned about that last in chapter 2. But for cash basis, we would record it because we received the cash. On December 1st, we pay 1 year of rent in advance, $500 per month. Did those expenses, those costs offset in the current period? No, these costs were prepaid as an asset. We debit prepaid rent, we credit cash. And so since that expense has not yet happened, we would not treat it as a cost. Cost hasn't been used yet. But under the cash basis, we would treat it as an expense because we paid it. On December 6th, we purchased supplies on account, $2,300, which means we debit supplies, we credit accounts payable. We purchased the supplies, but we did not use them yet, did we? So in this purpose for accrual basis, we're not going to record the expense, the supplies expense, until we use it. But for a cash basis, if we would have paid the $2,300 at the time, we would have recorded it. However, since it was on account, there's nothing we'll do until we actually pay for those supplies. Then we treat it as an expense. Then on December 28th, we paid salaries to employees, $2,800. Did the cost occur? Yes, we record it. Under cash, was it paid? Yes, therefore we record it. Remember, it's all about timing here. The difference between accrual basis and cash basis is timing. Under the accrual basis of accounting, we record our revenues when we provide goods and services to customers. We record expenses with the revenues they help to generate. Under the cash basis of accounting, we record revenues when we receive cash, and we record expenses when we pay the cash. However, remember, for generally accepted accounting principle purposes, the accrual basis of accounting is required. So guys, I'm going to start again, and 2 people must be making their morning coffee. Dylan, I agree with you. If they don't come back soon, they're going to get kicked out because I do expect people to participate in here. So I want all 11 of you to answer this. Which of the following would be recorded as an expense under the accrual basis of accounting? The company purchases office supplies with cash and does not use the supplies. B, the company uses utilities in the current period but does not pay cash. C, the company provides services to customers for cash. And D, the company purchases equipment by borrowing from the bank. Now, guys, remember, they're asking which of the following would be recorded as an expense under the accrual basis of accounting. Okay. So everyone says B. Now, I'm going to tell you something. You were smart. C would be revenues, not an expense. So awesome, guys. You are right in that it is B. The expense is recorded when a cost is used to help produce revenues. Even though we have not paid cash yet, we still treat it as an expense. How about this one, guys? Which of the following would be recorded as an expense under the cash basis of accounting? A, the company purchases office supplies with cash and does not use the supplies. B, the company uses utilities in the current period but does not pay cash. C, the company provides services to customers for cash. Remember, that would be revenue, not an expense. And D, the company purchases equipment by borrowing from the bank. What do you guys think? I need a couple more. You guys all said A. Awesome, guys. Awesome. Now let's work on this problem together. Guys, it's real easy to kind of look at a concept and go, yeah, I got it. But the reality is, to apply it is where we really know if we get it or not. So what we're going to do here is, in each situation, we're going to determine the date for which the company recognizes the revenue under the accrual basis of accounting. On this one, American Airlines collects cash on June 12th from the sale of a ticket to a customer. The flight occurs on August 16th. Which date will we recognize revenue under the accrual basis of accounting? Would we recognize it on June 12th? Or would we recognize it on August 16th? I'm seeing August 16th, and you're right on. Why? Because that is when the revenue, actually the service, was provided. On June 12th, the cash was received, which would have been a debit to cash, a credit to deferred revenue. And then on August 16th, since the service was provided, that's when the revenue would be recognized. How about this one, guys? A customer purchases sunglasses from Eddie Bauer on January 27th on account. Eddie Bauer receives payment from the customer on February 2nd. When would this revenue be recorded under the accrual basis, guys? Any ideas? Is that making sense, what I'm trying to say to you? It's going to happen when the service was provided, right? And if the service was provided on January 27th, that's when we record the revenue. What about this one? On March 30th, a customer pre-orders 10 supreme pizzas without onions from Pizza Hut for a birthday party. The pizzas are prepared and delivered on April 2nd. the company receives cash at the time of delivery. When did the service occur? When was the service provided, guys? On April 2nd. That's when the revenue would be recorded. Okay, I'm going to let you know something right now about this one. This is a little trickier, but it will make sense to you. A customer pays in advance for a 3-month subscription to Sports Illustrated on July 1st. Issues are scheduled for delivery each week from July 1st through September 30th. When will revenue be recognized, guys? When will revenue? Oh my goodness. Aliyah, I hope I'm pronouncing your name right. Aliyah?
Aaliyah.
Aliyah, you are right on. Each week, Carter, you're right on. Each week is when the revenue would be recognized because it is provided in increments. Since they purchased a subscription of a 3-month subscription, every week, 1 out of 9 or 10 weeks of that revenue, or the cost of that subscription, the revenue will be recorded each week when a new article goes out. Now, does everyone get that? Is it kind of making sense?
So for the homework, would it then, because I took a look at it and I saw these questions, would you put, I think it was like a no option. It's like a last option on there. Is that what it would be then, since it doesn't have the every week option as an answer?
Let me look, sweetie. Oh, excuse me, let me bring this down. So for the for the chapter 3 homework. No, I don't want that. I want students here. You guys had this as exact problem on your homework. Do you see that? Is that the one you're talking about, or is this the one you're talking about?
Yeah. Okay, so it would be the revenue would, okay.
So that's when, I mean, this is exactly the problem we're dealing with right now. So you've already got this all figured out. This
While
one,
we're, go ahead.
this one would be recorded as revenue each week.
Mm-hmm.
Okay, I'm sorry. What were you asking?
I was gonna ask, with the homework though, every time we answer it, is the how, like if you answer it wrong the first time, does that mark it as incorrect and that's when you get docked points on the homework,
No.
or is it after you check it?
The homework has unlimited attempts and you have unlimited opportunities to make it right. So you should be able to see what your grade is. If you initially show this and you check your work and it says it's wrong, then go and fix it. So if you go and say, revenues recognized as each, then you can go back, check your work and see it's right. So the only time it gets graded is when you submit your homework, when you hit there and submit it. You can take your homework and save and exit it and then keep working on it. But once you hit the submit button is when it gets recorded.
Okay, thank you so much.
You bet. Now, guys, I'm not trying to be mean, but I have a strict rule that I don't let anyone in after 8:10, so I'm not letting that person in. Again, I need to adhere to, what I set up. Okay, guys, let me go back to, where is my PowerPoint? There it is. Can you guys see my screen?
Yes.
Yes. Okay. Sometimes it kicks out, so I just wanted to make sure you could see it. Okay. So guys, moving on with this measurement process. What we are talking about here is there will be adjusting entries we are going to need to record prior to creating financial statements. This is after we've recorded all of the transactions for the period. This is after we've created the trial balance. Now we need to look and just make sure we take into account any adjusting entries. And we're going to talk about the 4 types of adjustments we're going to need to make. When we have a prepaid expense, know this. When there's a prepaid expense, the adjusting entry will always be a debit to an expense and a credit to cash. What do I mean by this? Prepaid rent, prepaid insurance. We paid it up front, but we treated it as an asset. And through the passage of time, it becomes an expense. So to adjust these prepaid expenses, we will debit our expense, which means increase our expense, and we credit the asset, which means reduce that asset. Unearned revenues, we'll talk about. It's basically like that plane ticket. When we get the cash, we debit our cash and we credit our liability, deferred revenue. But when we finally earn that money, we're going to get rid of that liability or debit it, and at that time, credit our revenue. Then we're going to talk about accrued revenues and accrued expenses. So let's talk about these. From January 1st through December 31st, which is the fiscal year, or the calendar year too. During the year, we record all these external transactions that have occurred with the company. Then at the end of the year is when we're going to record and post adjusting journal entries. That's what we're talking about. After we then record these adjusting journal entries, it's then we're going to prepare financial statements. And then we will record and post what we call closing entries. Now, we are just going today to get to understanding these adjusting entries and then preparing what we call an adjusted trial balance. Next week, we're going to talk about preparing financial statements and recording and posting the closing entries. We're only going to take that first portion today. So some transactions have occurred during the period, but haven't been recorded by the end of the period. Examples of these are these prepaid expenses, using supplies, earning interest, and rent expiring. We've got prepaid expenses, and we've got something called deferred revenues, which is the earning interest. No, I'm wrong. Prepaid expenses are what I told you about. Deferred revenues are exactly what I told you about. The accrued revenues will be what we call the earning interest, just because of a savings account, which we'll talk about. I don't want to confuse you. So here we have all these transactions. We have worked through these transactions, which were the various events that happened with the company, and we recorded these during the period. As we talked about earlier, but we'll go into detail, a prepaid expense are the cost of assets acquired in one period that will be recorded as an expense in a future period. The costs are initially recorded as assets because they provide us with a future benefit. But we expense these costs in the future periods as we use up those assets. A prepaid expense, guys, write these down, will always have a debit as an expense and a credit will credit an asset account, always. So cash paid for rent in advance. We record the prepaid rent, but when we initially pay that rent in advance. But by the end of the year, some of that prepaid rent has expired. So since some of it has expired because we paid for 12 months, it was December 1st, which means 1 month has expired. We need to then treat that as an expense. So we need to prepare an adjusting journal entry that debits rent expense for $500, and we credit our prepaid rent for $500. Why do we do this? We've used up 1 month of rent. It is no longer an asset. It no longer provides us with a future benefit. We've used it. Therefore, we debit our rent expense and we credit our prepaid rent because it's used up. Here's another example of a prepaid rent, a prepaid expense. Cash paid for supplies. Guys, when we purchase cash in advance, we record supplies and then we credit our cash. But when we go and look at our supply closet and see that we've used up $1,000 worth of supplies, and we really only have $1,300 remaining, we need to adjust our books to show a supply expense for $1,000, and we credit or reduce our asset supplies by $1,000. That makes sense? Next, equipment. This is a new concept we're talking about right now. $24,000 we purchased for equipment during the period. But by the end of the year, some of that asset's been used up. Even though we treat it as an asset, we still allocate a portion of that equipment that had wear and tear in the form of what we call depreciation. So in this example, we're showing that $400 of that $24,000 of equipment got used up. So we debit our depreciation expense and we credit a new account we're going to look at called accumulated depreciation. Now, guys, this is a whole new concept here. We use the word depreciation expense to keep track of the wear and tear of using equipment or an asset. The word accumulated depreciation is what we call a contra account. Instead of crediting equipment, we want to keep that asset equipment, it's in whole, its initial cost. And we use this contra account called accumulated depreciation. So we keep track of how much of that asset we have recorded or used in depreciation. So let's look at this problem here, guys. Golden Eagle Company prepares monthly financial statements for its bank. The November and December 31st adjusted trial balance includes the following accounts. It's also telling us some more information. So we know supplies as of November 30th was $2,000 as a debit. We know a month later, it shows $3,500. And then it tells us this information. And what we're supposed to do is show the adjusting entry that were made for supplies, prepaid insurance, salaries payable, and deferred revenues on December 31st. So it tells me the supplies were at 2,000, and then a month later they were at 3,500. It also tells us the purchase of supplies in December total 4,500. So what that means, guys, is that the purchases of supplies totaled 4,500. So if we started with 2,000 as a debit and we added 4,500 because we purchased 4,500 of supplies, that means we had $6,500 worth of supplies on hand. Does that make sense? This is November 30th trial balance. So to get to the December 31st trial balance, we take the account supplies of 2,000. We add 4,500 to it because we purchased 4,500 during the month of December. So 4,500 plus 2,000 is $6,500. But why is it, guys, on December 31st, we only show 3,500 in the supplies account? Well, wouldn't that be the difference? The $3,000 were used up. So we debit supplies expense for 3,000. We credit supplies for 3,000. This, guys, is an adjusting journal entry to show the supplies that were used during the month of December. Any questions on that? Does that make sense? One person saying yes. Does that make sense, guys? Okay.
So when it asks like a question on the homework or whatever, I'm not saying it says, but I'm just asking if it does. When it says like A, purchases of supplies in December total, and then that, so we just basically take that for the debit, it looks like, and then add it.
Okay, let me show you. A good, and please, guys, if you're asking a question, I don't know who just spoke, but guys, thank you, because this is the stuff other people are wondering too. So let me just say this. Whoops, sorry, guys. Okay, so let's just do it this way. Let's just show a T account. And we're going to call this Didn't we start with $2,000 here? Okay. It was November 30th. Okay. Then we know in December, let's just say December 5th, we purchased 4,500. Okay. But here's the deal. We can see what December 31st is. December 31st here is 3,500, isn't it? So what was the adjusting journal entry we needed to do to get to 3,500? Well, we needed to credit 3,000, which means we probably showed a supplies expense because we used up 3,000 during the month, and we credited 3,000 in supplies. That's where this 3,000 is coming in here. We probably know when we looked at the supply cabinet, we used up 3,000 in supplies. It's not there anymore. Therefore, this is why we have to record a journal entry. to show we don't have 6,500 in supplies. We only have 3,500 in supplies. Therefore, we need to create a journal entry to show they've been used up. The cost has been incurred, which shows a supplies expense of 3,000, and we credit our supplies of 3,000. Okay, next. Next shows no insurance payments are made in December. So we started November 30th with $8,000. If December 31st, we show 6,000 and we didn't buy any insurance during the period, what does that tell us? It tells us $2,000 of insurance was used up, has expired. Insurance is paid with the passage of time. So many of you know you pay for car insurance. You pay car insurance, and let's say you pay it once a year. Well, it's a 12-month policy. So after 1/12 or 1 month or 1/12 of the payment, that's used up. You're not getting anything back. Thank God you didn't need the insurance, but it's used up. So now it is an expense. That's what we're doing here. We're showing a debit to insurance expense of 2,000, and we're crediting prepaid insurance of 2,000. Remember, these are adjusting journal entries to show expenses just with the passage of time. Next, the following information is also known. $11,000 is paid to employees during December for November salaries. So what's happened to me, what looks like is happening is in November, there were employees that worked. So at the end of the period, so say the last 2 weeks, what probably happened was they debited salaries expense and credited salaries payable. Salaries were incurred, but were not paid yet. So then in December, when they paid those salaries, they debited salaries payable and they credited cash because it wiped it out. They owed that money. They paid it. Now it looks like at the end of December, we show 16,000 sitting in salaries payable. These are accrued expenses. These salaries occurred, they were incurred, they happened. We need to record it. We're not paying it until January, but we have to show the expense happened. Therefore, the adjusting journal entry would be a debit to salaries expense for 16,000 and a credit to salaries payable for 16,000. Here is accrued expense where the expense occurred. It was incurred by the company. So we show it as an expense. We show it also as a liability because we have not paid it yet. Okay. Sorry, I'm going to turn off my phone. It's making all kinds of noise. Okay. Last one. We see deferred revenue was $3,000 credit as of November 30th. And as of December 31st, it was a $1,500 credit. But we also know that on November 1st, so this is before November 30th, on November 1st, a tenant pays Golden Eagle $4,500 in advance rent for the period November through January. And at that time, deferred revenue was credited. So if you guys think about it, on November 1st, the company would have debited cash, credited deferred revenue for $4,500. Once a month had transpired, they now earned rent revenue. So they probably debited, or they did debit deferred revenue, credited rent revenue. What did they do in December? The same thing happened. Since the tenant paid for 3 months in advance, that means $1,500 a month. So at the end of December, we need to debit our deferred revenue, $1,500, and then credit, I called it rent revenue, service revenue for $1,500. I want all y'all to respond to this. Which of the following is recorded when an adjusting entry associated with a prepaid expense? What are we going to do? Are we going to credit an asset? Are we going to debit a liability? Will we credit an expense, or will we debit an asset? What do you guys think? You're exactly right by saying credit an asset. We debit the expense and we credit the prepaid or the accumulated depreciation. Now, we're going to talk about this depreciation. Which of the following is equivalent to the book value of an asset? Let's just look back at this. The book value of an asset, as you see here, is the asset minus what we call this accumulated depreciation, which gives us then our net book value of the assets. It's basically what the net after what we've taken into depreciation. Is it the cost of the asset plus accumulated depreciation? Is it the cost of the asset less the accumulated depreciation? Is it the estimate of time that the asset will last? Or is it the cost of the asset divided by its life? What do you guys think? Missing two more. Who are we missing? Okay. So it's the cost of the asset minus the accumulated depreciation. Now, deferred revenue occurs when a company receives cash in advance from customers. Initially, this gets recorded as a liability, but then once we've met the obligation or provided the service or the product, then we can get rid of that liability and record the revenue. We will always debit a liability because that reduces the liability, and credit a revenue account because credits increase revenues. Okay. So if we receive cash in advance from a customer for products or services, we would debit cash credit the $600 deferred revenue. But by the end of the year, some of those services have been provided. If we've provided $200 of those services, then by the end of the month, only $400 is listed as a deferred revenue. Therefore, we would debit the $200 of deferred revenue that we have finally provided the service, and we will credit our service revenue of $200. Now, we're going to look at another problem, guys. We are going to look at these and we are going to record the necessary adjusting entries at the end of the period. So what I want you guys to do, I want you to attempt these on your own. And then we're going to see who wants to take them and probably explain them. Okay? So I'm going to give you a couple minutes to look at this and then we'll go over them. Okay. Does anyone want to help with the first one? And it's okay if you don't, I can just go through them. But I figured I'd give you an opportunity if you're interested. Okay, Please try. Just unmute your phone and tell us what you think.
Okay, I'm not sure if I'm right, but I think that you would kind of divide the 4,500 into the 3 months, and each month it would be 1,500. So you would end up debiting deferred revenue for 1,500 at the end of each month,
That is
and
correct.
crediting service revenue. Yeah.
You're exactly right. So we would debit our deferred revenue for 1,500, and we would credit the service revenue for 1,500. Exactly, because it was $4,500 payment from a customer for services to be rendered evenly over 3 months. The next one, the company pays a local radio station $2,700 for 30 radio ads that are to be aired 10 per month throughout December, January, and February. Initially, prepaid advertising was debited. So what do we want to do here? $900 got used up. So we will debit our advertising expense for $900, and we will credit prepaid advertising for $900. Employee salaries for the month of December total $8,000 will be paid on January 7th, 2019. So we need to show this, it was incurred. It's an accrued expense. We debit our salaries expense and we credit our salaries payable. Guys, come January 7th, what will we do? We will debit salaries payable and credit cash. On August 31st, 2018, Shocker borrows $70,000 from a local bank. A note is signed with principal and 9% interest to be paid on August 31st. This again also is an accrued expense. If we borrowed the money on August 31st, how many months have accrued? September, October, November, and December, 4 months. We know that 9% interest is shown as an annual, a yearly amount. So what we would do is take our 70,000 times 9%, which would be the amount annually, or 6,300, divide that by 12 to come up with how much it is a month, and multiply it times 4 months. So we would be debiting our interest expense, 2,100, and credit our interest payable for 2,100. Remember, accrued expenses are recorded when a company has a cost that is used to help produce revenue, but hasn't yet paid cash for that cost. So we record the cost as an expense, and the amount owed is recorded as a liability. Again, salaries, employees earn salaries. At the end of the month, salaries are owed for 300. Then when we finally pay the salaries in the next month, that's when we will get rid of that payable. In this case, the adjusting entry as of December 31st is salaries expense. And it's at that time we credit our salaries payable. Since our period is ending, we need to record the expenses that have happened during the period, even though we haven't paid them. Guys, if a company pays an employee $100 per day for a 5-day work week that runs Monday to Friday, and December 31st is a Tuesday, what is the amount of the salaries adjustment, assuming that Friday is a payday? What are we going to say? Want it be 200? Because December 31st ends on a Tuesday, we need to record Monday and Tuesday's salaries expense for December. Also, let's say at the end of the year, utilities of $900 have been incurred but haven't been paid. We need to then show a debit to utilities expense, a credit to utilities payable, or interest. By the end of the year, 1 month of interest has been charged for borrowing $10,000 at a 12% interest rate. We need to show, even though we don't pay it, we need to show that interest expense, and we need to credit our interest payable. When recording the interest payable on a borrowed amount, sometimes people mistakenly credit the liability associated with the principal amount, such as notes payable, but don't do that. We record interest payable in a separate account called interest payable. So we keep the balance of the note separate from the amount we owe for interest. Guys, really important to remember that aspect. Guys, let's try to do this one. If a company borrowed $20,000 on November 1st at the rate of 6% annually, how much interest expense should be accrued at the year-end date of December 31st, assuming no accrual has yet been made this year? So basically, they're wanting to know how much interest would be shown for 2 months. Okay? I want you to let's just see recordings as everyone can see messages. Okay, so I want you to let me know what you think as to the amount of interest that should be accrued. So basically, 20,000 times 6% is 1,200. Divide that by 12 months is 100 a month. And since we're needing to accrue for 2 months, that would be $200. Again, accrued revenues are providing services and showing when a company provides products or services but hasn't yet received the cash, it's going to probably record an accounts receivable and credit a revenue account. So from December 28th through 30th, revenues of 700 were earned that haven't been billed yet. So we would show accounts receivable for 700, and then we would credit our service revenue for the same amount. Then let's say the next year we get the 700 cash. What we would then do is debit our cash and credit our accounts receivable. We aren't going to receive it anymore. We just received it. Guys, an adjusting entry would be needed for which of the following transactions? accrued salaries, services provided but unbilled, interest accrued on a loan payable, are all of the above. Every one of those would require an adjusting entry. The two kinds of adjusting entries that aren't necessary to record: any transaction that does not involve the recognition of revenues or expenses, such as borrowing, repaying debt, issuing common stock, and paying dividends, or transactions in which we receive cash at the same time we record revenues, or pay cash at the same time we record an expense. If that happens, we don't need to report any adjusting entries. Okay, so after we have prepared these adjusting entries, we will post those to the various accounts and then prepare what we call an adjusted trial balance. This trial balance is just a list of all the accounts. We start with our assets, our liabilities, our stockholders' equity, our revenues, and then our expenses. This is the adjusted trial balance after we've recorded all of our adjusting entries. It's from this adjusted trial balance that we will then create our financial statements, which we'll talk about next week. But remember, our total debits must also equal our total credits. Okay? So again, we talk about financial statements next week. Before I end this, does anyone have any questions? Any questions at all? Guys, I'm going to end the recording. Have a great week.